People with the best credit don't owe credit card debt. They don't have it. They have credit cards. You have to have at least 2-3 trade lines, 2-3 credit cards, revolving debts. But people with the best credit don't owe money.
What is important factors that drive credit score?
When I look at someone's credit and I'm going through their credit report with them, like a cardiologist, when you go to the doctor and they pull your EKG report and they know when you had a heart attack, when something happened in your life, when you were stressed out. So by looking at a credit report for me, tells a lot about what happened in someone's life.
How about if a collection is taking someone to court? What do they do?
One thing you have to realize, nobody's putting you in jail for not paying a debt. When you get that document, usually they warn you first and say, hey, listen, we're gonna take legal action on you. You're not gonna get pulled over for having tinted windows on your car and the cop says, hey, you owe Capital One $5,000. Let's go. Shackled up. They're not taking you in.
How about debt relief company? What do they do?
This is a hugely asked question. I get this call probably 15, 20 times a day. It's probably one of the biggest things out there right now. I'm going to tell you the steps real quick because this is probably the most important part of what you're asking me. This is for people that are in more financial turmoil at the moment.
Hey, Dan Gavay here from the Greer Real Estate team, and I have Adam Briggs here from National Financial here today. And we're going to be talking about credit. I'm super excited for this episode because I think a lot of us can relate to this. I'm sure during any of our time, we've had some challenges with credit and just wanted to give some value out there. And welcome.
Yeah. Thanks for having me, Dan.
Excellent.
Yeah. What do you have for questions?
So question is, why is having good credit so important?
Credit, right? Not just because I deal with credit and that's what I do. That's what I wake up for in the morning. That's why I go to bed. That's how I support my family. And it's not for that reason. Credit is the most important thing we all have. Folks that don't have great credit or decent credit have more expenses in life. So what do I mean by that? So we're not talking about the obvious with interest rates on credit cards, interest rates on vehicles, mortgages. What a lot of people don't know is your insurance rates, your homeowner's insurance, your automotive insurance.
Yep.
At least in Massachusetts, is affected by your credit score. Now, do most insurance companies say that to their the folks that are insuring with them? No, it's factored into the pricing. I promise you there are many people that actually get turned down because of their credit scores, so they have to go to a different carrier. So credit score drives interest rates, and when you can't borrow money at a good rate, it costs you more. People with bad credit, believe it or not, this is actually a fun fact for you. People with bad credit shop more at convenience stores. So they buy little things at a time and it costs them more money. You know what eggs cost at the grocery store compared to what eggs or milk cost at a 7-Eleven.
Right.
So you're paying more money for everything that you buy.
That makes sense. And I feel like a lot of people just don't have the education. They really don't know how credit works. They just figure, get a credit card, I have a max balance of $10,000, I can spend up to $10,000, and I just got to pay my minimum monthly. And they don't really know how the banks and the different people, like you mentioned, insurance companies look at it as, right? So I think today is all about educating them. So that's definitely good points. What is important factors that drive credit score?
So it's funny you just said a minute ago. So I want to go back to when I look at someone's credit and I'm going through their credit report with them. I like to not pretend, but like a cardiologist, when you go to the doctor and they pull your EKG report and they know when you had a heart attack, when something happened in your life, when you were stressed out, they can tell. So by looking at a credit report for me or for a bank, any lender, whoever's looking at that report, it tells a lot about a person. It doesn't mean it's a negative or even a positive, but it tells a lot about what happened in someone's life, whether they went through a divorce, a loss of job, a death in the family. Those things affect people's credit scores. Now, simple things to do. They're very, very easy. Pay your bills on time. Just pay them on time. One late payment can have a serious impact on a credit score. The higher your credit is, the better your credit score is, the more a simple late payment can have on your credit. And number two, there are two different types of credit. There is installment loans and there are revolving debt. Revolving debt are credit cards, to put it simply. Revolving debt, the payment changes based on how much money you owe on that debt. So if you have a $10,000 credit card when you go over 30% of that limit, which is $3,000, your score will drop. When you go over 50%, which is $5,000, your score will drop more. Why? The reason that your score drops is because I put it in words of, it's like a danger factor, right?
Yeah.
So, this guy has a $10,000 credit line. He owes $3,000. Danger, danger. Let's lower the score a little bit so he can't get more available credit.
Right.
He's 50% over. Danger, danger, danger. The impact to a credit score is almost identical between a late payment and having your cards maxed out or overutilized. However, when you pay the cards down, you will get those points back.
Okay.
Late payments obviously take longer the longer you get away from them, the more your score will start to climb.
Okay.
Make sense?
It does. It does. And as far as late payments, there's like, I know some, loans or payments have grace periods. Does everything have a grace period or not? And when does something get reported to the, credit bureaus?
Yeah, so good question. So creditors pay. Your creditors are your credit card companies, your auto loan, your mortgage. Creditors only report to the credit bureaus once a month.
Okay.
That's it. So when they report is different, depends on when their statement closing dates are, depends on when they're set up to report every month, depend upon the type of loan. So like a mortgage, generally speaking, you have a 15-day grace period before you receive a late payment. So if your payment is due on the 1st,
yep,
as long as you pay it before the 15th, you have that same payment.
Okay.
After the 15th, usually you're assessed with a late fee.
Mm-hmm.
When a mortgage goes over 30 days, then they will report you the first of, or whatever the date is that they actually report, then they will report you late that following month.
Okay.
So obviously that late will have a serious impact on your credit.
Now, would it be 30 days from the first to first, or not necessarily?
30 days after your due payment. So if your due payment's due on the 1st,
Yeah.
you technically have until the end of that month
Yeah.
to pay it.
Yeah.
And then you're 30 days late.
Okay. Gotcha.
And again, it's different. Like some items it'll report you late sooner. Credit cards, because you're borrowing that money ahead of time on a credit card.
Yeah.
You make a late payment, they can report you 30 days late sooner. Student loans, you actually, with the Department of Education, Navient, Mohila, all those companies that deal with most of the student loans,
Yeah.
they actually give you a 60-day grace period. And the reason for the 60-day grace period, there's just so many moving parts with student loans. So they're giving people the benefit of the doubt, like maybe they didn't read their email in time, maybe they didn't see the changes to their rate, or whatever the case may be.
Right.
So they wait 60 days till you're in default before they even report to a credit bureau negatively.
And so as far as a percentage of your maximum available credit, that's important to stay under a certain amount that can really affect your score as well, you mentioned, right?
Yes.
Is there like a rule of thumb percentage-wise if you get 10,000 available?
So here's how I'm going to put this, and I say this to everybody I meet with and everybody I talk. People with the best credit don't owe credit card debt. They don't have it. They have credit cards. You have to have at least 2-3 trade lines, 2-3 credit cards, revolving debts. But people with the best credit don't owe money. Under 30% is always your general rule. That's your safe spot. There's also, let's say you go apply for a loan, Dan, and you're looking for it's a big jumbo property, and you're looking to borrow $1.3 million.
Wow, I like this property already.
Yeah, you like this one, right? It'll come with a fireplace. So you're looking to buy this property, and the lender you're using says, "Hey, Dan, your credit came in at a 738. I need you at a 740 to qualify for this type of loan, which is going to save you a half an interest point or whatever the case may be."
Sure.
At that point, then you play the game. Now there's a game of putting a 1% balance on your credit card. So that $10,000 credit card, charging $100 on there.
Mm-hmm.
Make sense?
Yes.
So don't worry about that. Don't focus on that. That's for if and when.
Right.
Pay your credit cards off.
30%, you got 10,000, so you're talking, don't spend over 3,000 revolving
correct
balance at
and
all
you can
times.
spend it. You can spend, like business owners. I have a lot of friends that are in the construction industry, and they use their credit cards every month, $50, $60, $80, $100,000 a month.
Right.
But they report every month with zero. So what you want to do in that case, and you always want to keep your credit score up, you literally just call your credit card company or find out what the statement closing date is.
Yep.
You pay it off 2 days before that closing date, and it'll always get reflected with a zero balance.
Gotcha.
Because you don't want to have it's more the interest at the end of the day that's the bigger issue.
Right.
Why pay interest on your money if you don't have to?
Absolutely. All right. So we have, and as far as, how about collection? Should someone pay a collection or charge off, or what can you tell us about that?
So there are a million answers to this question. To answer it simply, don't do anything until you talk to someone like myself. So I'm going to say it depends. And what does it depend on? It depends on the type of collection it is, the type of charge off it is. It depends on when it happened. Again, we're saying someone's buying a house and they're going for a loan. They have a collection that's on their credit report for 5.5, 6 years ago, 6.5 years ago. Okay. It's easy for someone to say, hey, listen, go pay that off. It's $100. It's $150. Just pay it off. You got the money. You got 100 grand in the bank. Just pay it off. That can actually lower a score. Your score is factored in by your on-time payments. It's also factored in by collections, charge-offs, all that. But the biggest factor on a credit report is what's called the activity date. And the activity date is just another word for last payment.
Yep.
So what happens is, even though that item is in collection for the last 6 years,
yep,
because the last payment date was nil, it was never, it was 6.5 years ago, whatever it is, it has very little impact on a credit score. If you pay that off today, even though it's going to zero, it's going to show you have a paid collection last month. Your score is probably going to drop. Wow. There are also other factors in there. Again, by talking with someone like us, even if it's just a phone call, a lot of the collection agencies that are out there, your Resurgence, your LVNV, your Midland Funding, your Portfolio Recoveries, a lot of those companies are what called pay for delete companies. So what does that mean? That means you can actually negotiate your debt for less, or someone like us could do it, or I can guide you how to do it. You would negotiate your debt for less, or you could pay the full amount, whatever that works out, or how you need to do it. And they'll actually remove that debt from your credit, that collection from your credit, like it never existed. It's literally a trade line deletion. It was never there. And that's something that we can look at, and I can tell by looking at the type of company and how that is before we guide you that way. One thing we always want to do as well, if you're going to pay a collection or a charge off, always get something in writing before you make a payment. If you work out a settlement with them, get it in writing.
Good point. How about if a collection is taking someone to court? What do they do?
One thing you have to realize, nobody's putting you in jail for not paying a debt. Is it a terrible feeling when you get that court document in the mail? Absolutely. When you get that document, usually they warn you first and say, hey, listen, we're going to take legal action on you. So at that point, you've missed that letter or you ignored it. And now they say, okay, you have to show up to, is there a Taunton court? I would assume there's a court, Taunton court. It must be. It's a big city, right? Yep. We're taking you to Taunton District Court. We're suing you. Velocity is taking you to court for $5,000 on a Capital One card you had 5 years ago. Now, one, it's very important to know all the dates. In Massachusetts, again, it's different in every state. I believe New Hampshire is 4 years. There are some states that are 3 years. Yeah. Massachusetts, they have 6 years legally to come after you on an unpaid debt. That 6 years is from the last time you made a payment. That's why, again, it's important to talk to a professional. If you made a payment on that 6 years and a month ago and they just started suit, that's easy to throw out. Very easy. It's just, but you got to catch it. If they take you to court and get a judgment, it's game over. Right. So you have time. If you get that court document, don't worry. They're not locking you up. I have seen in some cases, they do put a capias on people, which technically it's an arrest warrant. They don't arrest people. You're not going to get pulled over for having tinted windows on your car and the cop says, hey, you owe Capital One $5,000. Let's go. Right. Shackled up. They're not taking you in. Usually you have 2-3 months. Give us a call. We'll get on the phone with them. We'll just get you in a payment plan. That's all they want. They just want to start getting money. Right. So you owe them $5,000. We go through a financial intake with you. Hey, you can afford $150 a month. Let's get you in a plan for $150 a month. Right.
Ever had anybody that didn't show up to court, and what happens in that case?
So there's a legal term called a default judgment. If you get a court document, just show up. Show up if you're not going to make a settlement or you don't agree to the debt. You get in front of the magistrate when you go to court. I'm not trying to give legal advice here, please. I don't even pretend to be a lawyer on TV. I promise you. So you go in front of the magistrate and you start pleading your case. Well, you know, hey, this wasn't my debt. This was that. It was fraud. I never opened this up. I filed a police report, whatever the case may be. Or you can prove insolvency. Proving insolvency just means it's another way of saying, I have no money. I make $5,000 a month and I have $5,000 in bills every month. As long as you can prove it, most of the time they're not going to file a judgment against you. They're going to say, okay, well, let's push this out. We'll follow up in 6 months or 12 months, whatever the case may be. You have to go to court. Now, if you don't go to court, you don't plead your case, it goes in front of the magistrate and they say, Dan didn't show up. He must be guilty.
Gotcha.
Easy done.
Okay. How about a debt relief company? What are they? Is it good to, like, what do they do?
This is a hugely asked question. I'd say I get this call probably 15, 20 times a day.
Wow. Glad I asked it.
Yeah, it's probably one of the biggest things out there right now. So what does that mean? So you and I were actually discussing earlier, you actually were showing me a chart on credit card debt being at $1.2 trillion right now.
Right.
That is huge. It has grown exponentially over the last 2.5 years. Before that too, but over the last 2.5, it's just been out of control. So what people are doing, they're overwhelmed now. They have all this debt. Let's say someone has, I'm going to give a round number of, they have $30,000 in credit card debt. And they're like, my minimums are crazy. Now, the reason their minimums are crazy is because they didn't have good credit. So they have high interest rates. These people are in the 25 to 33% interest rate range.
Yep.
Their minimum payments are crazy. They're like, oh, I need to settle this. So you see all these companies on TV, National Debt Relief, you see National Fixers. There are all these different companies out there that say, we'll settle your debt for less, get you on a payment plan. I'm going to tell you the steps real quick because this is probably the most important part of what you're asking me. This is for people that are in more financial turmoil at the moment. They tell you, the first thing they tell you, and they will not put it in writing because it's not legal to put it in writing, they say you have to stop paying all your bills. What does that do for your credit when you stop paying all your bills?
Oh, I can imagine.
There's a reason they're telling you to stop paying all your bills because your creditors won't settle for less until you're well defaulted.
Sure.
If you're paying them on time, they're like, no, just, we'll cut out some interest for a few months.
Right.
We'll take it down. We'll shut your card off maybe.
Nothing to talk about so much.
Nothing to talk about. You got money. You can just keep paying us. Again, we'll take out the interest. You stop paying your bills. And then what they do, they take that money. They say, okay, you owe $30,000. We know roughly in the industry, we're going to settle that for half price. So we're going to settle that for $15,000 mentally. They're writing this down.
Yep.
$15,000. And what they do, and people don't see it, it's hidden in their contracts. They don't talk about it. They charge you 25% of the starting balance of your debt. So that $30,000, they settled it for $15,000 after your credit is destroyed.
Oh.
They settle it for $15,000. And then they're charging you $7,500 to settle that $30,000. Now, you still are, at the end of the day, you're still saving $7,500.
Right.
You're still saving money. But there are ways that if you're going to stop paying your bills anyways, stop paying your bills, bank the money, and then settlements can be made. Let's say I need to do a settlement with you. We charge a few $100. We're not charging $7,500 to settle these debts. Again, we don't want you to stop paying your bills. There are other things you can do and whatnot that we can get into it at another time. There's different levels. But you do that, your credit, and they'll tell you, you're not going to take a huge hit on your credit. It's going to be a little bit just from the late payments. They tell everybody that. It is catastrophic. You literally would be better off filing for bankruptcy. There's a quicker recovery time from a bank. I'm not telling people to go through bankruptcy. But there's a quicker recovery time through bankruptcy than there is through that because your credit won't even start improving until all of those creditors are paid back, whether it's the in full or the full settlement that were worked out.
Yeah.
And they usually within a 3, 4, 5 year period of time. So your credit won't even start to improve for that 3 to 5 years.
Wow.
Make sense?
That's amazing. Yes.
So that's how those companies work.
And how do they get paid? That $7,500 that company made? Like,
so what they do is they figure out, okay, Dan, what can you afford? This is your income. They do a financial intake. Dan, you can afford to put $500 a month into it goes into an escrow account between you and them. They set up an escrow account. The money goes into that account. Then 4, 5, 6 months goes down the road, whatever it is. They settle those debts. They settle that debt and they start making payments, monthly payments to those companies. And they take monthly payments from you on everything that they settled. So it comes out of that escrow account. So what they do is they take that. We know we're going to sell a 30 grand for 15, plus we're charging you 7,500. Hopefully the numbers aren't screwing you up here. So you owe 22,500.
Yep.
Divide that by what you can afford, $500 a month, whatever that number is. That tells you how many months it's going to be. It's just, it's really all simple math. And everything is an estimate because they don't know if they can settle everything for 50%.
Gotcha. So read the fine print.
Read the fine print. I can guide people. There are better ways to do it. If you're going to destroy your credit anyways, there are better ways to do it.
How does someone consolidate debt?
To consolidate debt, it's important. And this is a great topic because home equities come up on this, right?
Yeah.
To consolidate debt, you don't have to have good credit, but you have to have decent credit. So there are different things called like, credit card stacking. That's more or less for business owners who they're borrowing money at 0%. But if you have decent credit, and let's say you got in trouble and you have $15,000 in credit card debt, but your credit score is still decent, it allows you to open up another credit card and start doing balance transfers. Hey, listen, the next 12 months of my life is going to be good. I'm making a lot of money. I can pay this debt back. It's okay to do balance transfers with 0% options when you know you're going to be paying it off. Biggest piece out there right now. So we talked about $1.2 trillion earlier in credit card debt.
Right.
What we're seeing now is a lot of people because housing prices have gone up so much in the last few years.
Right.
Because of inventory, whatever the case may be. You know more than that.
Yep.
I don't even pretend to be a Dan Gouveia on the weekends. So when you're doing that, so a lot of people have all this value and they want to pay off their credit card debt, so they're taking out home equity lines of credit, or in the industry, they call them HELOCs, as you know. It's very important people know a home equity line of credit, even though it looks on a credit report like a mortgage, it is not a mortgage, technically reporting-wise. It reports just like a credit card.
Gotcha.
So what happens is you take out, let's say you have $80,000 in credit card debt. So you take out an $80,000 home equity line of credit for 10 years, 7 years, whatever that is. Now you have an affordable payment. The problem is it can hurt your credit because now you've taken out an $80,000 HELOC and you've maxed it out. It looks like a maxed out credit card on your credit report. So it actually can pull your credit score down. Yes, you're paying off your credit cards and those percentages are going down.
Yeah.
The problem is it can be cyclical, right? We want to be careful. If someone's taking out a home equity, we want to make sure we do it the right way. We give them some coaching. That's where we come in. We'll give people advice how not to get in this trouble again. Because what happens is people take out these home equities, they pay off their bills, and then they're like, oh, I have all these credit cards with zero balances. Mm-hmm. You know how easy it is to book a vacation for $4,000 here, $6,000 here.
Yep.
And it gets out of control. And now their house is maxed out. They've taken out all their equity. Now they're using credit cards again. So
Gotcha.
we want to help. And we don't, just so you're aware, Dan, for your clients, anybody who sees this video, we don't charge to help someone when it comes to giving free advice or giving financial literacy. We don't charge for that. And the reason for that is there are enough people out there who happen to be broken or are victims of identity theft that need our help professionally, that need to pay us, that we love giving free advice. We like speaking at schools for that reason before these kids get out of high school, to train them on how not to get into that trouble again. Does that make sense?
Yeah, that's awesome. That's
I know
great.
I took that off topic a little bit.
No, that's perfect. So what are some of the myths you hear out there? You hear just people come to me sometimes, even thinking about before buying a house, and They're like, I'm going to pay all my credit cards off and I'm going to close them, or I'm just going to zero balance. And that's not necessarily a good thing to do, right? Like, what are myths out there that people you come across that people think is good for what they're doing, but it's really not?
So zero balance is good because what that also affects, it's your utilization. So you lowered your balances, so your credit score goes up. What it also does is by having that, getting rid of those payments on credit cards, when you're buying a house, we're saying this is for buying a house, it helps your debt to income ratio. So in layman's terms, you make $10,000 a month. When the mortgage company looks at it, they look at your car. Okay, your car payment's $800 a month. Now you only make $9,200 a month. Oh, you have $500 in credit card payments. Now you only make $8,700 a month. You get it? So your debt to income ratio, it allows you to buy more of a home. Okay. Now we don't want people just paying off all their bills like that anyhow when they're going into it, because they may need some down payment money or some closing money. That's where before you do all that, you want to partner with whoever's working with yourself and your lender of choice that or their lender.
Sure. You
want to do that the smart way so that you're not spending all they might say, well, that's great, you paid everything off, but you need like $8,200 to close on this property. So that's when you want to be careful paying things down. The other question you asked about closing cards. So the biggest part of your credit score, 35% of your score is paying things on time. Just pay your bills on time and you'll actually have a decent credit score. The second factor, which is 30% of your credit score. So 65% of your credit score, paying your bills on time and keeping your credit cards under 30%. If you do those two things, pay everything on time, keep all your credit cards under 30%, you're in amazing shape. You're going to have no worries in life. I promise you. The rest of the stuff we can deal with. One of the other big factors, the third biggest factor on your credit, is how long you've had a credit history. So if you've had a Amex card for 7 years, you had two Amex, you have an Amex and a Capital One for 7 years. You're like, listen, I learned my lesson. I got in trouble. I paid everything off. I'm good. If you close those two credit cards, you just lost 7 years of earned good credit history.
Good point, yeah.
So you never close credit cards. Now, there's another side to this. Someone had bad credit. We helped them build credit. They opened up this card, that card, this card. They now have 6 credit cards, which is fine, as long as you're being responsible. Now they have all these cards and they have monthly fees, annual fees on them that come with them, because when you have bad credit, remember I said it costs you more money?
Sure.
So a lot of these Merrick Banks, Credit Ones, they're on the prowl for people. So people are paying these fees. At that point, you have 6 cards you opened 5 years ago, and you have a couple of them that are charging you fees. Give me a call. Let me look at the credit report with you. I might say, hey, let's close that one or close that one.
Yep.
Your credit's good now. You don't need to pay fees anymore.
Gotcha.
But sometimes I might say, hey, listen, they're charging you $75 a year. Maybe it may make sense to keep that card, to keep your credit score.
So how about, like, some people come to me and they want to pay down their highest interest rate cards first? Is that a smart way to stop paying your cards down? Or
that's always the smartest way. You can follow and we've been preaching this forever, but Dave Ramsey is obviously a big gun out there. You agree with most of what he says. So there's a different approach, right? Yeah, should you always approach the highest interest rate? I mean, that makes the most sense logically, financially, to get rid of your highest interest rate card. The problem is people get overwhelmed. Let's say they have 6, 7 credit cards and they're all maxed out. The problem is if you're making minimum payments plus a little bit more to all your cards, mentally it doesn't help people and they don't succeed. So what you want to do, even though it's maybe not the highest interest, attack your smallest card. So you have a card that you owe 10 grand on, you have a card you owe 8 grand on, a card you owe 3 grand on, a card you owe 500 on. Take care of that one with 500. Mentally, it's pleasing.
Right. Wow,
I did it. And maybe don't pay off the $3,000 one, but when you attack that $3,000 one, get it under 50%. Then go to the next one. Get that one under 50%. There are many ways to do it.
Right.
You could either attack one at a time, pay them off, and just pay minimums on everything else to keep your credit up. Or you can get one to 50%, get the next one to 50, then the next one to 50. Then you can come back and go 30, 30, 30. So there's many different ways to do it, but mentally to help people out, for people, because if you're going after that $10,000 one,
It could take a while. Yeah.
it might take you 2 years to take it.
Right.
Yeah, but how satisfying is it? I had 5 credit cards and I got rid of 3 in 3 months.
They want to feel those small gains.
Yeah,
Get
so
excited, keep rolling with it.
Right.
Yeah.
So it's almost like a mental
Yeah,
thing.
I like it. Yeah, it makes sense. How about if someone's just starting off and they don't have any credit, never had a credit card, they're just starting out and, they're getting denied with certain things because they have no credit.
Right.
So where would one start there?
So your worst case scenario is you need a secured credit card. A secured credit card is just like it sounds. It's secured by your own money. So you can go to a local bank. You could go to your credit union. You can ask them if they have them. Believe it or not, one of the best places you can start is on, I'm plugging this company again, but I promise you I don't have any stock in Capital One. Capital One has a soft pull to start. You go around their website. Always want to make sure you're on their website and not a sponsored page. Please don't apply through things through Credit Karma or any of those. They're in it to win it. They get paid for when people apply for things. Go to Capital One. They do a soft pull and they tell you if you're pre-approved. So if you're not approved for a regular card, which you may not be because you're a credit ghost, they'll approve you for usually a secured card through them. And their secured cards require you to put down between $60 and $200, where a lot of the banks require you to put down between $300 to $500. Basically what you're doing, you're putting $200 down, and then you're borrowing against that money. And again, same rule applies, be under 30%. Once you have that card for probably 60 days, 90 days, now you have a credit score, you're in good shape. Now we can get you a regular credit card. Makes sense? And then the longer you have them, when you hit a year, your credit score is going to jump. When you hit 2 years, 2 years is the magic number.
Right.
2 years, your credit score jumps more. And then, like we said before, it's the third biggest factor. So the longer you have your credit, the more your score is going to increase.
Is there anything that I didn't ask that you think maybe we should touch on? Anything else besides you can give the folks advice on?
There's no dumb question. You can call, you can text, you can email myself. There really just there's no dumb question. I hear all the time, well, my friend, I was at a party, someone said this, my rabbi, my priest said this, like, stop. They said I need to use my card, carry a balance, make minimum payments. No. So there are many different ways. So just always ask the question. Just ask. It never hurts. Perfect. It's a numbers game. Here's how it works. The 3 credit agencies, Experian, Equifax, and TransUnion. There are more. There's LexisNexis. There's Dun & Bradstreet for businesses. There's many different ones, but the 3 main ones we use here in the United States, they love when people don't have great credit because it costs money every time a credit report is pulled. And if you don't have great credit, when you get pulled for a mortgage, guess what? They got to pull your credit again when you think you fixed it. Right. And then they got to pull it again before closing. It's got to be pulled again and again. So if everybody had great credit, everybody's credit would be pulled one time. They'd get a loan. And that's it.
Yeah, makes sense. Yeah, absolutely. Well, that was some great information. I think there's a lot of good points that you make. And if someone wants to learn more information or maybe look into some of your additional services, how would they get a hold of you?
So the name of the company is National Financial Credit Group, or National FCG. We're located in Braintree. We're next to the movie theater up the hill. You can reach me at 617-600-4414. My email address is adamb@nationalfcg.com. Again, you can text me at that number. You can call me. You can email me. I'm easy to talk to. I'll usually respond unless I'm having dinner. There's usually a little bit of a pause there. But Dan knows. Dan will text me at night. I usually get back to him. So
absolutely.
Yeah. Remember, no question is a bad question.
Good advice. Good advice. Well, here you have it, guys. He's the credit doctor, so give him a call. Reach out to him if you have any questions. I hope that was helpful. Adam, I appreciate you coming in.
Dan, thanks for having me.
I learned a few things myself, and I'll carry that to my clients as well, and I appreciate you coming in.
Yeah, I feel like Tom Silver on This Old House.
Thank you.